Oh, all right, let's start. Thank you everyone for joining me today. Today is August 20th, after the market close. We're going to go through a few things today. The first section of this webinar will focus around the upcoming Jackson Hole, what potentially Fed or Powell could speak about. We go through several of the Fed speakers, what they said earlier this month, and to gauge where the Fed is at in terms of the next rate cut. And we go through the possibilities of a 50 versus a 25 basis point cut in September. And also we're in the second half of the webinar, we're going to go through some of the trade setups we already have in this service. So let's get started. All right, so since our dramatic crash at the beginning of the month, we've had three Fed speakers who are voting members of voting or alternative voting members of the FOMC speaking to the press. So first, Mary Daly, then Raphael Bostic from Atlanta, and Austin Goolsbee from Chicago. So Goolsbee is an alternate member, which means that he will vote when there's when someone's absent from the existing voting members. So Daly said in an FT interview recently that she is becoming more confident that inflation is under control now, but she prefers a gradual way of cutting rather than fast and furious. So for her, gradualism is not weak, it's not slow, it's not behind, it's just prudent. So, and also for her, the labor market, while slowing, is not weak. So that concurs with what Powell said in the FOMC last month about the labor market being in a normalization process rather than having some serious softening issues. Bostic said that he needs more data before he's ready to support lower interest rate. So he's even more hawkish than Daly. And he wants to be sure that the Fed avoids cutting rates too soon, only to have to raise it later if inflation reaccelerates. But he did concede that rates should be lower by the end of the year. So it sounds like he wants just to see one cut. He thinks we don't need to rush still. We still have time to see more data to be sure. And to be fair, back in two or three decades ago, it did happen when the Fed eased off the pedal, cut rates, and inflation came back, and they have to hike the interest rates again. And that can be a very detrimental scenario for the economy. And it just disrupts everyone's inflation expectations as well as the financial conditions. And finally, Goolsbee said in a CBS interview that when you set rates high like we have and hold it there while inflation falls, you're actually tightening. And if you keep it too tight for too long, you'll have a problem on the employment side of the Fed's mandate. What he's really saying is that if you think about interest rates as two components, the real interest rate as well as the inflation, which together make the nominal interest rate. When inflation falls, if you hold the nominal interest rate at the same level, the real interest rate actually rises. In that sense, the financial conditions are tighter, as in interest rates are too tight for the level of inflation given. And then he's talking about the second part of the Fed's mandate. The Fed keeps an eye on inflation, but also has to make sure there is maximum employment, which by definition is if you want a job, you can get one. And so this week we'll have the Jackson Hole Economic Symposium, and the topic is reassessing the effectiveness and the transmission of monetary policy. So this is the annual gathering of central bankers, policymakers, economists, and journalists together in Jackson Hole. And it happens usually in the final week of August. The Fed uses this opportunity to essentially talk about big themes of the monetary policy. So 3 years ago, they talked about a flexible inflation targeting, moving away from a fixed stated number of 2% to a sort of range between 2 and 2.5%. So we don't really know what they're going to talk about precisely within this topic, but I think this is basically the opportunity the market has been waiting for the Fed to address the weakness in the labor market and to clarify how eager they are to act and cut interest rates in the upcoming FOMCs. So Jerome Powell is actually going to speak on Friday at 10 a.m. And you can watch it on YouTube. So I will definitely be following on YouTube. I can give live commentary as it happens. And I think there will be quite a big reaction in the market because the market has been yo-yoing between 25 and 50 basis point cuts. And 1 week we're thinking the recession's coming around the corner, and another week we have strong retail sales data, and we're thinking, oh, actually everything's all good. So the sentiment really is really shifty at the moment. So this is the big question. Will Powell open the door for 50 basis points? So the Fed loves to communicate early and with clarity on what they want to do, so not to run through the market. So if the market is aggressively pricing in a rate cut or a rate hike that the Fed doesn't like or doesn't see, we will address the market early on to avoid a last-minute surprise. Not every central bank does this, but the Fed is famous for doing this. And so the question is Powell going to say something that will hint towards a 50 basis point cut, or at least give the possibility of the 50 basis point cut? I think the truth is that whatever he says right now will likely disappoint the market because there is so much build up to this point. So nothing he will say will ever be enough. And also Powell does not ever really want to be quite cornered with another 2 sets of data. So non-farm payrolls in early September, first Friday of September, as well as CPI data in mid-month September before the next FMC. So he doesn't, I think he's still not quite want to commit to 50 basis point. I think he will definitely be happy to say the Fed is willing to act if once they gain the full confidence, which should be by the next set of data. But I think the 50 basis point is a little bit stretched at the moment. And if you look at what the Fed speakers said earlier, the 3 speakers, I think one is neutral, one is very hawkish, only sees one cut, the other one, Gooseby, is a bit more dovish. So there is a lot of people you still have to convince in the room for the next FOMC to get to the 25 basis point, let alone the 50 basis point. So I think the September data has to be quite ugly for the 50 basis point to happen. And I don't see that the Fed committing to it at Jackson Hole. And let's just look at, so with the September FOMC, there will come about another set of economic projections. The economic projections comes every quarter in March, June, September, and December. And it's a chance for the market to understand what the Fed is projecting in terms of GDP and employment rate, inflation, as well as the dot plot where people in the room are seeing the interest rate should be for this year and next year and 2026. So let's just compare where we are now versus the June FOMC, right? And that, I think that better clarifies the parameter around whether we should have 25 or 50 basis points. So it looks like, so in June, the Fed projected an unemployment rate of 4%. We're now at 4.3. So if we go further in the next set of data, let's say to 4.4, or even stay flat, we're quite above what the Fed had projected in March as well as in June. So I think there's no denying that this 4.3 is above what people thought would happen. So I think basically 25 basis point is definitely no question. It's just whether this, 30 basis point difference in unemployment rate is sufficient to push for a 50 basis point cut. In terms of inflation, the headline inflation now in terms of PCE is at 2.5 and core inflation 2.6. Again, these are below the June projection, but sort of in line with the March projection, the earlier prediction the Fed had. So I would say inflation is basically pretty much on track, and unemployment is slipping. I think that another ugly report in September can provide the catalyst for the 50 basis point. And I think if that happens, I think a lot more Fed members will be on board with the more aggressive route. As you can see, it's the velocity that really matters. This 4.3% from the last set of reading is significantly above what we had in the summer last year. As well as we've gone through those charts before, but just to recap, hourly earnings are also going down, which means core inflation is likely to go down. Core inflation is inflation without food and energy, so it focuses on shelter and services. And core services inflation is kind of a function of the hourly earnings growth. We had a set of headline core CPI data last week. They rose by 0.2% month on month, both quite benign. And now you can see that both headline core CPI are still on track on the downtrend. So the headline is now below 3%. Core CPI is just slightly above 3.2%, but still trending down. And if you look at the 3-month annualized, on a 3-month annualized basis, so this just means we take the last 3-month data and extrapolate for the whole year. What does that mean? It actually shows that headline inflation is basically disinflationary now. So it's basically flat. Core inflation is within the target of 2%. And services less rent, so it's basically the super core, is actually at 0% on a 3-month annualized basis because it's printed 0, 0, 0 on 3 times. And that's quite, so all of this should send a dovish signal for the Fed, because it's quite clear that in the short-term trend, we're moving towards at least disinflationary territory. And unlike what we had at the end of last year, where it was just mainly from the goods, we actually have services inflation coming down significantly. So let's play the devil's advocate. So what would be the deterrent for a 50 basis point cut? So if we look at shelter, which is a big part, which shelter accounts for more than 50% of the inflation reading because it's weighting, it weighs 30%, and it is also really high. So together, they influence the CPI a lot. If you look at the trend, we had flat go between February and May, and then we had a downtrend in June, down reading in June, and all of a sudden we had an uptick again in July. And this was a little bit puzzling because from the rent index we went through with Zillow and RDA data, everything was actually pointing towards further downtrend in July, but the CPI print is actually higher. So this might be something that the Fed is still not very comfortable with. They had been expecting shelter to slow down given high mortgage rates, and housing activities are slowing in terms of the overall demand as well as supply, but it's not really manifested through shelter in terms of CPI yet. Motor vehicle insurance also ticked up, and that's another big component of the overall reading. But again, this is a lagging indicator. Is a lagging component in terms of the trajectory compared with new vehicles and used car sales. So fewer cars sold, you can see these are all in deflationary territories now, which means fewer cars are being put on the road and lower insurance, hopefully, over time. And just to visualize this point, the 3-month annualized basis for shelter is still quite sticky and actually even ticked up 1 from last month. So this might be the source of concern for the Fed. Where are we in the market now? So the market had regressed the aggressive pricing that they had at the beginning of August. At the moment, we're pricing in a 40% chance of a 50 basis point in September, as well as a 40% chance of 50 basis point in December. And the way this is priced, the way the futures are pricing it this way is because with the economic projections that I said that is released every quarter, the September and December meetings are just ever so slightly more important than the November and the January meetings, because the Fed can bring more material to justify why they're doing something. So 35 basis point, it basically means 25 basis point is for sure, and there's additional 10 basis point of cut pricing, and 10 out of 25 of additional cuts is a 40% chance. So overall, it means 25 basis points for sure and 40% chance of 50 basis points. That's how you read those tables. I think the alternative way is you can go on CME and there's some sort of calculator that do it for you. But this is the way I have done it back on the trading desk as well as now. It's a more straightforward way to see what the market is pricing for each meeting. Again, the market still expects the terminal rate to be above 3% and all the rate cuts to be done essentially by next year. So I actually pinned this chart. I pinned this chart in the chat channel. This is just showing where we are in terms of the overall stock market valuation versus forward returns. And it's very simple. It's SP 500 PE multiple on the horizontal axis versus the 10-year annual CAGR, so annualized returns in terms of forward looking, right? So if in the next 10 years, if I bought SP 500 at a 30 PE multiple, what do I expect the returns to be in the next 10 years on an annualized basis? And the red dot is where we are now. I think we have a PE of 29. It might be higher since this chart is printed. It might be 30 now. And what it really shows is that with a higher PE, if you're paying for a higher PE, your chance of hitting above 5% CAGR is basically very low. And there's quite big risk of losing money actually in the next 10 years. Once you move below 25 times PE multiple, your risk of losing money is very small. And it's virtually impossible once you pay below something below 17 times PE multiple. And your chance of making double-digit returns is significantly higher if your PE multiple is below 15 times. So right now, if we're just looking at PE on its own, in terms of longer term horizon, the returns are not very favorable. It doesn't mean it will crash next year. Actually, in terms of 1 year forward looking chart is quite random. But it means if you're a long-term investor, now is not really a great time to invest, which is why people like Warren Buffett are holding, record high cash levels. I think he's got something like $270 billion of cash parked at Berkshire Hathaway. But I think I've brought this chart before. We also look at earnings yield versus the 10-year treasury yield. And the yellow line is spread. So what this means is the earnings yield is basically 1 divided by PE. So it's flipped. So how much earnings how much percentage of earnings do I make from each percent, from $1 of my investment? And if you work it out as so people tend to think the earnings yield versus 10-year treasury yield as a spread to be the risk premium for equities. If you think about it, if you can get 5% on 10-year bond, why would you risk on in earning 4% on SP 500 in terms of earnings? It makes sense. And actually, for most part of the past decade, this spread or risk premium for equities is positive. It has recently inverted to the negative territory. But if we look at further back, from 1970 to 2000 to the financial crisis, we actually had a negative spread for a long time, and equities obviously still went up during that period. So so I think the answer is a bit more nuanced. It doesn't. I feel like just because stocks are cheap or expensive, it doesn't mean it can't go higher, because relative to 10-year yield, it moves in line with the 10-year yield. If the 10-year yield is coming down, there's room for SP 500 to get more expensive, at least in the short term. And if we put in the chart that spread versus the forward CAGR, again, then the picture is more nuanced. If you have a positive risk premium, you basically won't lose your money. Actually, you will consistently get above 5%. So we're just around the minus mark here. We're not on this side of the graph. We're on this side of the graph right now. Once you move to the negative risk premium for equities, you can have high returns, you can have low returns, but there's no guarantee of success, essentially. So if you're a long-term investor and you're thinking about deploying cash aggressively, you might want to wait for this spread to move further to the right, or for PE multiples to kind of reduce a little bit in terms of longer-term investment. Again, so this is the seasonality chart, where now in the final weeks of August, final 10 days of August, so we have to look ahead to what September might bring. This is the SPY and QQQ seasonality charts, monthly charts, since for the past 2.5 decades. And generally, January starts gentle, and we have good March and April. February is always weak. June is typically weak. August typically weak, which we kind of felt this month. But September is actually the worst month across the whole year. So if you want to play the seasonality factors or you want to put money to work, you might pay to wait for September to finish. And typically October and November are quite good. The caveat is that, sorry, I have to refresh this page just to make sure. The caveat is that September and October in election years are very, very bad for SPY and QQQ. So we don't really know. Obviously, we're not even in September yet, but we already saw some sort of a lot of volatility this month. And actually, August in election year is meant to be a very good month. We didn't really get that because of the crash at the beginning of the month. We have seen pretty strong recovery though, which is always promising. But I would warn that these charts come from a much smaller sample size than the previous charts, because obviously elections only happen 1 in 4 years. But anyhow, so in any type of years, September is going to be a rough month. So that it just pays to be patient if you think about deploying capital. This is another chart I've produced recently. So this is essentially the past SP 500 returns between August and October on an absolute basis versus who won the election, right? And this is who won the election is divided into incumbent and challenger parties. So obviously in the past two elections, the challenger party won, which is Trump from Republicans in 2016 and Biden from Democrats in 2020. What you could see is that when this August to October return is negative, even slightly negative, just like 0.1% negative, the challenger party usually wins. Actually, in fact, they've won all of the scenarios. When the return is positive, usually the incumbent wins, with the exception of this year, and that's the year Jimmy Carter won. So the year, this is the year that Jimmy Carter won, and then he lost the re-election here. So if you want to put on a bet on who's going to win the election, or if you want to start thinking about what sort of trades will be favorable in terms of who wins the election, we actually will know the answer essentially by the market close on Halloween. And we can, I think, in the next 2 months, I'm going to work on, the potential Trump stocks versus Harris stocks. Although, truth to be said, Harris is more like incumbent and on the tighter regulation side. So it feels like the stocks that are working now should continue to work. Whereas when Trump comes in, there might be, a different set of stocks that work in terms of deregulation or even crypto, etc. So we're going to draft the list in the upcoming month. And I have a feeling that it's going to be very different to 2016. So now it's a good segue to get onto the real charts. So before the CPI report, I showed this chart to the chat room because what we had was that ahead of each CPI release, market was going up, and it usually goes up for 3 or 4 sessions. And then it will consolidate or even fall flat off, which is the case in July. And yields usually come down after the CPI report. And we essentially have got the same scenario here this month. Equities rallied into CPI. It's been 3 sessions of green bars. Today is stalled, which I thought would be the case coming into this week. I said if market is going up into Monday or Tuesday, it's a good chance to start taking some risk off the table, especially ahead of Jackson Hole and September weakness. We also have yields coming down a lot. Admittedly, it went up the day after, but now it's essentially recovered all of that spike. So I think right now is the season to think about risk management, and in terms of your cash deployment, and whether you want to take profit or just kind of manage the downside aggressively, because things will get volatile from here. So now I'm going to share a different screen to talk about our trade setups. But actually, before we get onto the trade setups, I just want to ask if anyone has questions. Just unmute yourself and we can, yeah. All right. So if no one has questions, we can get on the actual trading view charts. Are we here? All right. So here, so now we're on trading view. We're just going to track all of the trade setups I've mentioned the past 2 weeks since starting the service. So firstly, yields. We picked TLT, which is the 20+ year treasury bond to start with. I think so we made wave 3 high after the Monday beginning of August crash, and yields yields essentially recovered some in the 30-year bond, and we had a pullback, wave 4 pullback. And now I think we're progressing towards wave 5. I think this wave 5 could happen going into the next set of non-farm payrolls. I'm not entirely convinced we'll get it this week from Jackson Hole, just because I think Powell might get a little bit wishy-washy right now. But if unemployment stays high or even higher, bond market will definitely reprice in further recession. So for more cuts, essentially. we really want to see this get above the wave 3 high to confirm we're, in wave 5. But it's made quite a lot of progress since we started the wave 4 low. Similarly, in TLH, which is the 10-year bond, we're also progressing towards wave 5, which is pointing towards 112 in TLH. I just want to mention one thing. Between TLH and TLT, there is, so the advantage of using TLT, which is has longer duration, is that when yields fall, because the duration factor, TLT will outperform, will rise higher than the shorter duration ETFs. But there is a risk associated with that, which is that if you think about the US deficit and the budget, if you feel that the budget deficit is at an unsustainable level, and the Treasury has less wiggle room in issuing more bonds, etc., and there's going to be volatility in the market in terms of bond demand, and especially if the Fed is not as dovish as what people think. Do you want to the 30-year yields could actually spike higher than the 10-year because of the issuance risk. So that is something worth thinking about in terms of the overall, the budget deficit sort of thing. So the 10-year or the TLH should be a bit safer from that point of view.
You mean?
So now, go on, yeah.
Sorry, we still see the screen from your previous SP 500
okay.
The US government.
Okay, so 1 second. Let me reshare. Good, thank you for telling me. I really appreciate that. So, how about now? Yeah. Can you see everything? Yeah. Oh, good. All right.
Yeah.
Okay. Let's start with the 30-year again. So with everything stood as what I said about the TLH versus TLT, but with the TLT, I think we are heading towards wave 5 now. Wave 4 pullback should be complete. It's a very clean pattern essentially, and when the market crashed on August 5th, and the yields essentially fell off the cliff, I did say that we're meeting the target and we expected a wave 4 pullback, which we got. Admittedly, this wave 4 pullback was slightly steeper than I expected. I expected it to be 95.7. It got to 94.91, but the levels are still pretty clean from here. And I'm still expecting wave 5 target to be met just above 101. So between 101 and 102. And the 10-year bond yield and the TLT are the same. We're having a wave 4 pullback complete, and we're progressing towards wave 5. So I think so the reason I've got those targets is because of where the wave 3 landed. The wave 3 was was a very sharp spike basically, and so for the wave 5 target, I expect to be at least a couple of fib levels above where we landed on wave 3. Now going to Bitcoin, so I followed this very closely, and actually it has largely evolved against what I expected before I had a yellow alternative path, which was invalidated. And what we have had now is we had from the August low, we had a very clean set of wave 1, wave 2, 5 waves up and 3 waves down. And we completed this wave 2 last week. And at the time I flagged the trade to say, I think now is quite a nice entry. If I were to enter here, I would, I think I mentioned around over here, 57.7K. I would put a stop against this August low, and I'm actually playing for all of waves up. I'll show you in the larger degree picture in a second. But I think right now we're now in wave 3, and we've had another wave 1, wave 2 setup in wave 3. We had a slight pullback from this morning, but I still expect these 5 waves to complete at 66.7K. If I just zoom out to the wider chart, I expect the longer term target to be 94K for this. It could be, this is a conservative estimate. It could well be way above, but this is where I would start taking risk off the table instead of trying to push through the 100K. Because what I often see is that to get to 100K, or to get to this like round number everyone's expecting, the final mile might just really disappoint people. It might get to 92K, do a big pullback, and then finally break through 100K, because a lot of people already anticipate this break and want to sell ahead of the crowd. So I do see wave 5 commencing, and we're in the heart of wave 3 of wave 5. I do see this correction largely finished, but obviously for me to be completely sure, we need to get above the previous wave 3 high, which is 74K. We still have a way to go, of course, but that's when you completely know for sure that wave 5 has started. All of this is a probabilistic. It's never going to be 100%. And don't believe anyone who says 100% Bitcoin will be 100K next week or something like that. No one knows, essentially. And I think with Bitcoin, all the charts I have seen, all the rationale for price action I've seen so far is on the supply side of things, like stock to flow. It takes, 100 years to mine the equivalent. I mean, you can't really mine more than another 2 or 3 million Bitcoins anyway, because the halving. But the stock to flow ratio takes a long time to recover all of the Bitcoin stock. But it doesn't really talk about demand. And also the Powell law is essentially an extrapolation of past price action to the future. So essentially the logic is that what happened in the past will happen in the future. And I think both of those logics are quite dangerous because, the music often does stop at some point, and that's, and nothing will always only ever go up just because it has gone up before. So I'll just be very cautious. I will try to stay neutral in terms of not being too bearish or bullish about the fundamentals, and just see where the price takes us. It's a very sentiment-driven commodity as well, or asset. So I think it's quite dangerous to get really married to one side or the other. Now moving on to gold. Gold, another non-interest yielding asset. So past week we've covered Bitcoin, gold, and silver, and the overwhelming theme is that none of them is making real cash flows, and that in itself is not a problem. The problem is that when you hold Bitcoin, gold, or silver, you're essentially foregoing the risk-free rate you can get from, let's say, the 10-year treasury yield, right? And what that means is that when interest rate goes up, it just makes the demand side of the assets a bit weaker, because people can switch to, there's a stronger opportunity cost for people to hold those assets. But inversely, if yields are going down, it should elevate those assets, because there's less pressure in terms of opportunity cost. You think of it as there's less headwind, and there's more opportunity for for speculators to come into play. With gold, the gold is very different to silver and Bitcoin, because gold is owned by central banks, and that is actually the biggest distinction in my mind between gold and everything else. This is because while you could argue all the other assets are store value over time, etc., because of limited supply, but you have to have a very but gold has a authority figure behind the demand. right? Central banks actually do buy it and lock up in the vault, and gold is literally like not controlled by any one government. So I would say that in terms of fundamentals, gold is still the strongest in my mind. I think between the three commodities, silver is weakening because now the younger generation are preferring digital currency, cryptocurrency in Bitcoin, and silver and Bitcoin have a similar market value, which is 1.5 trillion. So I think they're both competing for second place. So to me, the silver probably has the weakest fundamentals because it has more industrial use. A lot of demand supply comes from making electronics, etc., and less about jewelry and store value. So if I was to rank the three, I would say gold first, Bitcoin second, and silver. But silver has a longer history, so the second place is quite hard to say right now. But gold is in a bull market. Is in a very strong bull market, and I think we're in the heart of wave three of I will zoom out to the larger degree, but it has enjoyed a huge tailwind from emerging market central bank buying from Russia, China, India, Brazil, Turkey, and all of the countries. These countries, they want to essentially decouple from the US financial system as much as they can. When Russia invaded Ukraine, the US froze $300 billion of Russian assets. China holds a ton of US treasuries. So, because of the complications in the geopolitical moves, I think those central banks are really looking for a different way to store value and use as financial reserve than US dollars or US treasuries. So gold is in a bull market. The only reason it's not traced up right now because it's gone up so far into this wave three target, towards wave three target. I see an imminent pullback, and historically, gold has pulled back after Jackson Hole and into September. So there's quite a big seasonality factor here. So I would not rush into buying gold right now, personally. I would wait for a pullback, maybe after September. But if you just zoom out into the longer term target, I think, if you are not that bothered about the entry level, etc., I see at least another 50% in this larger degree wave five. So I'm very bullish. I think central banks, emerging market central will continue to buy. Geopolitical situations are not improving that much. So I would look for an entry essentially for gold. Silver is a trade that is a bit tricky because silver has actually not recovered its all-time high yet, and I think that's linked to, and that is because it's part commodity like copper and lead, and part store of value because of historical reasons. And in a recessionary environment, the commodity properties will play more. The silver price falls further than gold because it's treated more like commodity, and people much prefer owning gold than silver. In a normal environment, silver moves up with gold in essentially in very correlated moves. So my mind is a bit torn in the sense that I would say in the long term, I'm quite neutralish on silver. I would much rather own gold and just kind of like have my peace of mind rather than playing the silver, which is a bit more uncertain, especially if we have a recession around the corner. But relative to, in terms of gold silver ratio, silver is quite cheap. Gold has run a big bull market recently, and I think silver can play catch up. And I can see that silver is in wave five of this larger degree, wave three. So I flagged the trade alert on Friday after I wrote the analysis. It's gone up slightly, but I see the upside to $34 before a larger correction. And I just want to pull up the chart for gold silver ratio. This is the ratio I'm talking about. In the past 10 years, essentially, it's moved between 70 and 90. So when the ratio is high, it means silver is cheap relative to gold. So you can buy. So gold is worth more ounces of silver, right? 85 ounces of silver right now. I can see. So this is quite range bound in the past couple of years. So I can see silver playing catch up and this gold silver ratio revert. But I would not really do this as a pair trade. I would just be long gold or long silver, depending on what you feel as the opportunity or value is. I wouldn't go short gold and long silver just to play this ratio, because gold is very bullish right now, and this ratio could widen before it drops. Finally, moving on to the stocks, we've followed Tesla quite a while now. I think Tesla is in a larger degree wave 5 of the cycle wave 3. And the cycle wave 3, it just essentially started before COVID, when and during COVID, Tesla made 100% year-on-year increases in revenue, et cetera, et cetera. We've had a steep correction, have not quite recovered the all-time high yet, unlike the other Magnificent 7 stocks. But I think the investors have accumulated for a long time now, between 2021 and today. And I think if you look at, forget the Elliott wave theory, this is the inverse head and shoulders. I think wave 3 or 5 has started. The tricky part is that the price action goes before fundamentals. So in the fundamentals, we're actually seeing, quite flat year-on-year growth, production flatlining, everything. We haven't really seen the fundamentals pick up yet, but I feel like the price action is leading the way. And for Tesla owners, the reality is that right now it is a car company, and because it makes most of its money from car sales. But the big picture that Elon Musk is pitching is robotaxi and the human robot that they have in the factory, and those could be $5 trillion markets each. And the advantage of Tesla in terms of robotaxi is that if you thought about Uber, when Uber had to conquer city after city to map out the drivers, incentivize demand. In terms of the software, Tesla could actually overnight just switch on the robotaxi software, turn it on, and every Tesla car can become a robotaxi, and Tesla can get a revenue share. Some people might buy extra Tesla just for the robotaxi itself, rather than using their own cars. But that is the future that Elon Musk is pitching anyway. Obviously, so the robotaxi demo has been delayed from August. We should have seen it by now, but we haven't. Apparently, they're tweaking design still, and they're going to be released in October. But for this cycle 3 to get here, and Cathy Wood to be vindicated, essentially we're playing on the robotaxi story from here. So I would argue Tesla is a speculative bet. It's not quite based on the current fundamentals, but many people have tried to short Elon Musk and have failed very miserably. I'm just going to zoom into the charts here. What we see now is we're recovering from this August low again. I think we've seen a 1-2 setup. That's when I entered the trade myself. We're now near wave 3. We're actually pretty much just like we essentially surpassed the wave 3 target. So wave 3 could be anywhere between 225 and 230. I think I did say that. I think I sent an alert saying that if you're happy, over here, you could have taken some risk off to bank 11%, 12% gain versus the 3% risk, which I thought was quite good risk reward. I've moved the trading stop to 210 because that's the next most obvious stop. I probably wouldn't put it here just because how volatile markets are. So I think wave 3 is basically close, if not complete. We can see a wave back for pullback before hitting wave 5 in the short term. So that's where I see in the short term. Myself, I'm trying to ride all the way to wave 5. But yeah, so there's no shame in taking profit here, essentially, especially if you think about the broader stock market weakness that's coming in September. Amazon, I covered Amazon today. I think Amazon has the best valuation in terms of valuation fairness multiples among the Magnificent Seven stocks, arguably except for NVDA, because NVDA is growing really super fast. And it's not really comparable. But compared to Microsoft, Google, Apple, and Tesla, Amazon is valued pretty, I would say, pretty fairly, revenue multiples and PE ratio, etc. And also against its e-commerce competitors like Shopify, eBay, and Walmart. I think the valuation is pretty good. I see a potential setup here for 1-2 setup. I'm personally long already. I entered after the crash, but in the short term, we potentially get a wave 4 pullback, complete wave 5, and then a bigger pullback for wave 2, which could be an ideal entry if in terms of risk reward. So I just want to stress this point about risk reward. I think if you enter now and you play to this wave 5, you get 30% upside, which is not bad. But if you place a stop at the August crash low, that's a 15-16% stop. You have to win at least 30% of the time, 1/3 of the time, to justify the risk. And I just don't feel it's that worth it. You know, having a risk reward ratio below 2 is not that great. Always look for above 3, because this essentially gives you a lot more room to be wrong, right? You can be wrong 5 times here and you still break even if you have this setup. And hopefully we're not wrong 5 times and we will make some profit. But the better the entry, obviously, the higher the upside. So I do think it pays to be patient. And also you can play, in terms of my positioning, what I do is that I look at potential losses. Okay, 7% here against my portfolio loss. I can accept, let's say, $1,000 worth of loss on this trade. And then I work out my position sizing according to how much I'm willing to lose. A smaller stop loss means I can play a bigger position so $1,000 worth of loss, as a 7% of my 7% is a much bigger position than 15% loss. Let me just explain it this way. Actually, this way might be easier. If you lose the same amount of money, the position sizing on a 7.5% stop loss is double of a position sizing if you entered here, right? So you can really afford to take a lot more risk here than here. Here, you have much less room to be wrong. So that's how I look at it. So I'm waiting for, say, if I hadn't entered, I would wait for this pullback. Finally, NVIDIA, again, when I covered it, I think the stock was here. Again, I wouldn't enter here. I'm a bit two-minded. It depends on what you want to do with the stock. The stock has not made past the all-time high yet. There's every chance that this is the all-time high in the near term, and the stock will never get past it. And this is just a wave A, B, C pullback down here. In the chance that actually we're in the wave 3 and wave 4 here, and there's I think at the moment it's equal probability to me. It's not that obvious that this is the all-time high yet, and it's not that obvious that we will have another all-time high given how much the stock has gone up. If you want to play this possibility of 3, 4, 5, a wave 5 and one more high, I will still wait for this pullback here. It might never come. We might never enter the trade, but again, it gives us a good setup, a good risk-reward ratio. We can be wrong 3 times and still break even on this trade versus if we enter now and we have to be right quite a lot. And finally, going on to the 30th of August, which is the earnings day, I actually don't necessarily think there will be a pullback, which means I might never be able to enter the trade. Because on the earnings day, if you look at the past earnings, most of the time, so NVIDIA has never surprised to the downside. And, 70% of the time, the stock has reacted positively to earnings the next day. And when it reacts to the downside, it's very limited. Only twice did it move below -3%. And, nearly half of the time it moves above 5%. So the bet for the earnings specifically is, to me, is asymmetrical. But if you want to play the one day roulette on the earnings, it looks like a quite good bet. But if you're playing for this wave 5, I would wait. Essentially, that's my personal preference. So I think that's it for today. It's been quite a long webinar. Does anyone have any questions on any of the things we've covered?
Hey, Yumin, thanks for thanks for going over NVIDIA. I'm actually in that trade right now on the short side, so I'm wondering what your risk and reward looks like for shorts.
Okay, so it's if we look at where this, so let's play the devil's advocate on this chart and say wave 5 has topped already, and this is a ABC correction to the downside, and it would seem to me that we are actually so we're basically at the, so this is the inverse, but it's retraced 78.6% of this move, which is quite a big retrace. I would say from here, if I were to enter here, the stop would be literally like, if it went past all-time high, it probably will go much further to finish this wave 5. But in the short term, I do expect a pullback. Even on the long side, I do expect a pullback in the short term. I would play between now and earnings. I would just kind of, it gets quite tricky, because if let's say we got ABC correction here, where would this short go? And I would expect wave C to land around 70 actually, because that's the 1.236 extension of wave A, and typically you will see a 5 wave down. So I think to zoom onto the micro on the hourly level, what we want to see is that from here I would stop out if it goes past all-time high. But actually, if we can make 5 waves down from here, that is a very good signal. Maybe not even on the hourly chart, unlike the 10-minute chart. I think that would be a very encouraging initial sign that you're right. But obviously, once it goes past here, it should go past, get towards 70, and this trade will be invalidated. So it's very similar to, it's basically the opposite of what I had just now in terms of the long trade setup, because my stop loss would be just below this wave 4 low. I think if it gets past this low, it will just fall all the way down to wave C here. To me, at the moment, it's a 50-50. So I would kind of monitor whether, so essentially between now and the all-time high, it's not that long, right? But I would want to see on the micro level if there's a 5 waves down, and if there is, we can potentially either pull back to here, or if it gets past wave 4 low, we can get down to here. I will keep an eye on this, because when it gets down here, I'll probably flag the trade, and then obviously for me, I'll be stopped out here, and you might make a lot more money. What I would say is that generally, I wouldn't get too married to the idea of whether this is all-time high or this is all-time high. We just play the chart as it comes, and try to react to it rather than trying to, because technical analysis is very subjective, and even the best of the best would admit that this is something of a probability experience and pattern recognition. So there is definitely no certainty around what if any of this would happen. Yeah. Yeah. Or alternatively, if I did hold a position now, I'd probably think about reducing my risk exposure going ahead into the earnings, just because the earnings reaction tends to be asymmetrical to the upside historically. So that's how we think about it. Does that answer your question?
Yeah, it's helpful. What other indicators are you using to, or what are you looking for to determine sentiment in the market as we look at these minute shifts in direction, as we look at price? I've been trying to use volume and see where things are at, but that's really difficult and subjective sometimes.
Yeah. So if you're looking at pure Elliott wave analysis, which is essentially what I'm heavily leaning on, because I've used indicators like MACD, RSI, etc. I think those are, for me, are more secondary. So if we just go into the very first principles of Elliott wave theory, is that the motive trend, which means the main direction, is in 5 waves. And the corrective waves are in 3 waves. And this is for both the stock moving up and moving down, essentially. So the reason that, so this is why the reason, if you look at the chart analysis, when we're looking at the motive wave, we're always looking for the 5 waves up rather than just 3 waves. And if you are looking, so in terms of Elliott wave analysis, if to determine where the next move is, if you get 5 waves down from here, and that could be on the like 10-minute chart even. So for example, right now we don't have that. So if we have like wave 1, wave 2, wave 3, wave 4, wave 5, even if we get that, that's an early indication of a downturn, because that the 5 wave is the motive wave is the main trend. So that's kind of the fundamental basis of Elliott wave theory. So the reason we use Fibonacci levels is to determine how far each wave on a certain level could go on, right? So if we have 5 waves, so wave 3 is typically, anywhere between 1.382 to 1.618 level extension of wave 1 placed at wave 2 low. So if it gets to here, there's a quite good chance that actually we've topped. But once it completes this 5 wave pattern, wave 4 being, retraces to somewhere like 0.78, and then wave 5 at 1.76 to wave 2. If it retraces to those level, which is 120, it's likely we've actually topped and wave C has begun. And then what a lot of people do is they enter the short side over here. So wave C, 5 waves down, and you want to see a corrective 3 waves up from here. Wave up, and people tend to enter short side on here. So that's the -1 2. It's the mirror image of what we had on the long side. So that would be the early warning sign that we already had an all-time high and we're moving down. Does that answer your question better? Because I actually don't look at stuff like RSI and MACD anymore. You can see my chart is quite clean. I feel like those things, like you said, like once it hits RSI 70, it could go higher. But useful things are like RSI divergence. Have I got RSI here? Let me see. Indicator.
Yeah, I don't use any other metrics. I'm using fibs and learning in Elliott wave to be able to do this, but then trying to see where sentiment, like I don't know, just try to get more information on where things are heading or likely to head. So I've been using tram lines and trying to spot patterns, but is volume reliable at all to see, or what, like interim steps on like even smaller scales, like 1-minute charts,
Yeah. Volume is important because volume essentially. So you can see so volume is quite important in the sense that a price, you can print a high price and is thinly traded. It doesn't really matter. It's not that important versus the area like here where most of the volume on this chart has traded at 104. So I would actually think about market in terms of very first principles of what. So imagine if you didn't have a chart and you are a trader in a bank and someone come ask you for NVDA and to buy at 127 for $1 billion worth of notional. Compare that, how you feel about that, and whether you want to hedge, whether you think market will go up, versus someone comes to you and say, I want to buy at 127 at just a 10 million notional. It's a world of difference. You might not even want to hedge the small trade, right? So the first principle is that higher volume obviously is high interest, but that price is much more real. And the person on the other side of risk, whoever sold it short to that person, likely has to recover. So recover the position, and there's a lot of momentum behind it. So yes, the volume is important. It's one aspect of things. I try to look. So I do look at volume, but I also try to think about the markets in terms of what's the path of least resistance as well, right? And when we have the overall market going up so high, and NVIDIA has been a huge component of leading the way, it's very difficult, I think, to be, even if you feel like it's top, it's very difficult to short it, just because the bullish sentiment doesn't die down that easily. And if you zoom out into something like the weekly charts, okay, maybe not the weekly. It's big. Even if you zoom out here, this is still an overall uptrend. So I think for me, I wouldn't really short this stock unless it falls off the cliff over here, like unless it falls out of this entire channel. And that's kind of also the reason why I'm playing devil's advocate. I don't necessarily feel like wave 5 has finished. It doesn't feel to me that wave 5 is already finished. There's always a chance of going higher. Unless I see the price actually printed to the downside, it's just a thesis, right? At this moment, whether it's topped or not. So for me, and also the second part is that it doesn't. When we take trades, it's a probability game, and a lot of it is a volume game. It's not really about whether this specific trade works out or not. If we're having the right risk management tools, like having the right stop losses, right risk reward ratios, you can be wrong more than 50% chance and still make money, because every time you make money, you make a trade, you're making more than double of what you were risking, right? So overall, you should be making money even if you're wrong most of the time. And that's the game we're playing. We're not saying we want to be right every single time. And there's no way we are right every single time. So if the trader has gone against you, if you're really uncomfortable, it's really good to set up the parameters of where the stop losses are and where your thesis could be invalidated. And any thesis could easily be invalidated. It's really important not to carry the losses for too long, essentially, in terms of trading psychology. So indicators, I don't think there's a silver bullet for indicators. You can look at divergence, the price is printing higher, RSI is coming lower, so we're near the top, there's a downturn, etc. But these are all secondary confirmation signals. I think it's really important to just essentially take the market as it is and have really good risk management tools. And even if we're wrong, more than 50% chance, we're still making money. I know it doesn't answer the question about, is there a silver bullet on having 100% trade record? But I feel like this mental model could help printing more profitable trades in the long run. I don't know if that helps. Does that help a little bit?
Yeah, it's helpful. We're just scratching the surface. Yeah, thank you.
Yeah, I think over time, I will share a lot of my thoughts on this over time, and also like you can track my trades live right on the spreadsheet now. So I'll have a lot more colors on how I think about trades, and hopefully that would be more helpful over time. But yeah, so essentially, I don't think there's a silver bullet, like a one indicator that works all the time. And the reason is quite simple, because if there is something that works, everyone will catch on to it. And it will stop making money because it's becoming crowded. So it's like a combination of things. And not to run on too much, it's the reason why my analysis has both fundamentals and technical analysis. Everyone's really interested in looking at those charts and levels, and because they look quite sexy and fun and easy to digest. But I think the fundamentals really laying the context on where the company is in the overall cycle and how it's relating to other companies. For example, NVDA sells chips to at least 4 or 5 out of the other 6 Magnificent 7 stocks, right? Everyone's buying NVIDIA chips right now to build AI. And you could say that these other companies are probably the suckers and NVIDIA is the winner, right? And all these other companies like Meta and Amazon and Google and Microsoft are saying, we're not finished yet. We're going to spend more money on CapEx every year from now, at least in the foreseeable future. So it's really tough place for me to short NVIDIA here. It could have topped, but if I were to short, I would have really strict risk management tools. And I feel like the fundamental side does help me a lot in understanding the overall scheme of things. Yeah. So any other question? Yeah.
Would be interesting to get more into teaching how to set stop losses and measure risk and reward in the future.
Okay, that's perfect. Yeah, that's perfect. I think I can run an article on this, and I can talk more about it. It's more like in the next webinar. That's a really great suggestion. Thank you. I can actually walk through the math behind how I set every trade as well. And actually, if you look at my Google Sheet on the second tab, there's a lot of content in there that already explains how this trade is triggered, set up. And on the third tab, there's notes which talk about what everything means. But I will talk more about that in person, and I will use live examples on how I set those, how I do those trade setups and position sizing. So thank you for that suggestion. Does anyone else have any questions? If not, we can end the webinar, and I will record this and upload to YouTube as usual. It will be with you either tonight or early morning tomorrow, depending on the speed. All right. Okay. So thank you very much, everyone. I really appreciate joining me today. And I'll see you on chat or next week. Thank you.